All right, if you're here, you're probably already paying attention to markets. So do me a favor and stick with me for a few minutes, because something important is happening right now. Over the last few weeks, you've watched precious metals get absolutely slammed. Billions wiped out, gold down hard, silver hit even harder. It looked violent, fast, almost panicked. And while most people were focused on the crash itself, something much quieter was happening underneath it. China didn't flinch. China didn't stop. In fact, the data shows China kept accumulating. And when that happens after a metals crash, that's not noise. That's a signal. Stay with me, because I'm going to show you why this matters, how to recognize this pattern yourself, and why this isn't about fear, it's about positioning. Before I explain what caused this divergence, let me slow it down and teach you something most people never really learn about markets. You need to understand the difference between paper markets and physical demand. Futures, ETFs, leverage, all of that trades at lightning speed, millions of contracts moving in seconds. Physical metal doesn't. It can't. Think of it like a crowded theater. Paper traders are the people closest to the exits, reacting instantly to any smoke. Physical buyers are sitting down, calm, deciding whether the movie is actually worth staying for. When volatility hits, the exits get chaotic. Prices move fast, panic spreads, but the people sitting down, they don't suddenly forget why they came. They're not rushing anywhere. That distinction matters, because when you understand it, you stop confusing price action with actual demand. You start asking better questions, like who's selling and who's buying what they're selling. Now here's what's actually happening. Let me break down the sequence, because this is where it gets interesting. The primary driver of the crash was futures-driven selling. Rising yields, dollar strength, forced liquidation, margin calls. That's the mechanical stuff. When volatility spikes like this, leveraged players sell what they can, not what they want to. They have to. It's not a choice. That pushes prices lower, fast, really fast. You've seen those candles. Those aren't decisions, those are forced exits. Now here's the secondary confirmation, and this is where you need to pay attention. While Western paper markets were dumping, official data showed the People's Bank of China added gold for the 14th straight month through December. 14 months. That's not timing a dip. That's not opportunistic trading. That's policy. That's institutional behavior. At the same time, silver inside China stayed firm. Why? Because physical demand didn't collapse, industrial demand stayed strong. Retail buying stayed elevated. And starting January 1st, new export controls tightened supply. So when paper prices fell, physical markets didn't follow. That divergence is the key. When you see paper selling and physical buying happening at the same time, you're watching two different movies. And here's the part most people are missing. When paper selling hits a wall of real demand, the imbalance doesn't disappear. It doesn't resolve itself quietly. It builds pressure. Think about what's actually happening here. On one side, you've got forced sellers dumping contracts to meet margin requirements. On the other side, you've got a sovereign buyer stepping in month after month, accumulating physical metal. Those two forces don't cancel out. They create tension. And that tension has to resolve somehow. If this is making sense so far, drop a comment and let me know, because I want to make sure you're seeing what I'm seeing. Now let me show you why this should make you nervous, but also why it should make you think. Historically, when you see a major buyer step in during extreme volatility, especially a sovereign buyer, it's rarely about short-term price action. They're not day trading. They're not looking at the 5-minute chart. It's about risk management. It's about reserves. It's about trust. China has been very clear over the last decade that it wants less exposure to dollar-based assets and more exposure to hard assets. They've said it. They've published it. They've acted on it. So when prices fall and they keep buying, they're telling you something without saying a word. They're telling you they view this as accumulation territory, not danger territory. They're telling you they're comfortable adding here. Now, you can agree with that assessment or not, but you can't ignore it. Zoom out for a second, because this isn't new. This is the same playbook you saw in the early 2000s, when central banks quietly shifted from net sellers to net buyers of gold. For decades, central banks were dumping gold. Then, almost overnight, they flipped. And they didn't announce it with fanfare. You had to watch the data. It's the same pattern you saw after the 2008 crash, when physical demand surged after paper markets broke. Premiums spiked, shortages appeared, mints couldn't keep up. And it showed up again in 2020, when price volatility masked what was happening underneath. Remember March 2020? Gold and silver got crushed along with everything else. But within weeks, physical buyers stepped in hard. Premiums exploded. Every time this has happened, the short-term narrative was chaos, fear, uncertainty. But the long-term result was repricing higher once the imbalance resolved. When you look at the pattern, the story isn't about crashes, it's about who's buying when others are forced to sell. That's the pattern. That's what you need to watch for. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this be wrong? Absolutely. China could slow purchases. They've done it before. Demand could soften. Recessions change behavior. And not every divergence resolves immediately. Sometimes it takes months. Sometimes longer. And no, this doesn't mean prices can't go lower first. Markets don't owe anyone a straight line. They don't care about your entry point. But here's the thing, you don't need certainty. You need probabilities. And the probability shifts when physical demand stays firm during paper liquidation. That's not conspiracy. That's not hopium. That's structure. That's how markets work when leverage unwinds and real buyers show up. There are probably 3 types of people watching this right now. The first is the trader. You're focused on charts, momentum, entries, exits. You're watching the tape. That's valid. For you, this tells you not to confuse volatility with trend shifts. Volatility is noise. Trends are built on structure. Watch the divergence. If paper keeps selling but physical premiums start rising, that's your tell. That's when you know the forced selling is hitting real demand. Your risk is getting chopped in the middle, so if you're trading this, trade the structure, not the emotion. Don't chase the dump. Wait for confirmation. The second type is the long-term holder. You care about purchasing power, not weekly candles. You're thinking in years, not days. For you, this reinforces why accumulation phases rarely feel comfortable in real time. They just don't. Every major bottom in history felt terrible when it was happening. If you're building a position, this is what it looks like. It's not clean. It's not obvious. It's messy. And honestly, that's probably why it works. If everyone felt confident, you wouldn't be getting these prices. Your job is to stay calm and stick to your plan. Don't panic out because the price went down. That's the whole point. And the third type is the skeptic. You think this is overhyped. You think metals people always have an excuse. Fair. I get it. My advice to you is simple. Watch the data, not the headlines. Watch what physical premiums do over the next 4 to 6 weeks. Watch what central banks do. Watch what supply constraints do. If I'm wrong, premiums will fall. Demand will soften. China will slow down. You'll know. But if I'm right, you'll see premiums hold or rise, even as paper prices stay volatile. And that gap, that's your confirmation. The universal principle for all of you, no matter where you stand, is this. Price is information, but behavior is confirmation. Watch what people do, not what they say. So here's what I want you to answer in the comments. Which type are you? Are you trading this? Holding long-term? Or watching from the sidelines? I'm genuinely curious where your head's at right now, so here's where I stand. I'm not panicking. I'm not chasing. I'm watching. Let me tell you what I'm personally watching. First, I'm watching continued official gold reserve data from central banks. If China continues adding through January and February, that confirms this is institutional policy, not tactical trading. Second, I'm watching physical silver premiums inside Asia. If those premiums start expanding while paper prices stay weak, That's the divergence widening. That's the imbalance building. Third, I'm monitoring whether paper markets keep diverging from real-world supply signals. If you start seeing delivery delays, if you start seeing mints reporting shortages, if you start seeing refinery backlogs, that tells you physical markets are tightening even if futures prices don't reflect it yet. Based on my analysis, this crash was mechanical, not fundamental. The fundamentals didn't break. Industrial demand for silver is still strong. Central bank behavior is still accumulating. Supply constraints are still real. What broke was leverage. What broke was positioning. That's different. When leverage breaks, it creates opportunity for those who weren't forced to sell. The question isn't whether metals are going to zero. The question is whether this imbalance between paper selling and physical buying creates the conditions for repricing later. And historically, when you've seen this pattern, when you've seen forced selling meet institutional accumulation, the move that followed wasn't small. If history rhymes and physical demand continues absorbing paper selling, the resolution could be sharp. I'm not making a prediction. I'm telling you what the pattern suggests. This isn't financial advice. I'm not a financial advisor. Do your own research. Verify everything I've said. Check the data yourself. But understand the mechanics. Understand what you're watching. If you made it this far, you're thinking critically. That mentality will serve you well. Most people react. You're analyzing. That's the difference. That's what keeps you ahead. If you found value in this breakdown, share it with someone who needs to see it. Subscribe if you want more pattern recognition like this. And stay sharp out there. Think critically, verify the data, and make your own decisions.